Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. So Q3 estimated tax payments are due by September the 15th. Now let's jump straight into a pop quiz. Assume you did a Roth IRA conversion of $50,000 on August the 1st, 2025. Further assume that you expect your marginal tax rate for 2025 to be 24%. So the question is, do you need to make an estimated tax payment specific to this transaction of $50,000 times 24% equals $12,500 of payment by September the 15th? And the answer to that question is, let's go to the Number Crunch Nerds Safe Harbor estimated tax calculator and figure it out. All right, so we're in the Safe Harbor estimated tax calculator, and the first thing I'm going to do is go over here to Q3. I'm going to go to this cell right here, and I'm going to go ahead and make that cell yellow so we know which item we are specifically talking about for purposes of this video. Now, starting right back up here, what is the information that you need or that anybody needs to determine the amount of estimated tax payment that they have to make for any quarter during the year, whether it's Q3 or otherwise? Well, the first thing you have to know is your prior year AGI. So for this example, let's assume that the current year is 2025. That would make the prior year 2024. You need to go to your actual tax return from 2024 in this example and get your prior year AGI and put the number right here in this cell. You also need to know your prior year total tax. And again, that comes off of your tax return for 2024 in this example, and you need to get that figure and put the amount right here in this cell. Now let's stop for a minute and make sure that everybody is following. Based on these two pieces of information right here, do we have enough to calculate what our safe harbor is under one of the two acceptable methods? And the answer is yes. You can base your safe harbor off of prior year information, and the prior year information you need is actual AGI and also the actual amount of total tax. Going right down here, as many of you recall if you have been following my channel, one of the two acceptable safe harbor methods is 100% of the prior year's tax or 110% of the prior year's tax if prior year AGI was above $150,000. In this particular case, looking right up here, we do see that prior year AGI is above $150,000. Therefore, under this method right down here, the prior year method, we would expect the amount of tax calculated as the total estimates due to be 110% of the prior year's amount. Just eyeballing it right here, you can see that the prior year's total tax was about $40,000, of which 10% of $40,000 is $4,000. And when we add those two together, we would therefore expect the current year's safe harbor based on 110% of the prior year's tax to be about $44,000, which is exactly what we have right here. Okay, but now what about the other safe harbor method? The other safe harbor method is based on a current year projection. So if we go right up here, enter the current year's total tax, the projected amount for the current year, because after all, if this is 2025, the current year, well then the current year is not over as of the recording of this video. As of you watching this video, if you're watching it in 2025, then 2025 is not over. If you're watching this video next year and you have this item changed to 2026 and you're watching this video in 2026, then guess what? 2026 is not over. So if you're basing your estimates on a current year projection, by definition, it is a projection or an estimate because the year is not over yet, and therefore you can't know with 100% certainty what the current year's total tax is going to be. It will, by definition, as I've said, have to be some some kind of an estimate. Now, putting this back to 2025 for purposes of this example, if you are new to my channel, you might be looking at this and saying, wait a minute, how do I calculate a projection or an estimate of the total tax for the current year? Well, if you are someone who asked that question and you are new to my channel, when you're done watching this video, I suggest you go on YouTube and search for this video right here. It is called Roth IRA Conversion, How to Calculate. There is a number 1 in the corner right here. This is the first video in a 10-part video series on how to calculate Roth IRA conversions. I suggest you watch videos 1 through 4 of this series because it is this video series that will teach you how to project current year's total tax, which you can then use for purposes of figuring out your estimated tax payments based on a current year projection. So let's just assume that we did that. We used the personal tax planning template, which is what you're going to find in that video series on Roth IRA conversions that I just mentioned. And using the personal tax planning template, we calculated the current year, again, this is 2025 for this example, the current year total tax to be $58,996. Okay, now with that in mind, safe harbor calculation number 2 is going to be 90% of the current year's projected tax. We just said this $58,996 is our projection for the current year, and therefore 90% of the current year projection is going to be $53,096. So with those two numbers in mind, what is the actual safe harbor total, the grand total that we need to pay for the year? What number of these two is it going to be? And the answer is it's always going to be the minimum. Whichever of these two safe harbors is smaller, that is going to be the minimum safe harbor that you need for purposes of paying your estimated taxes so that you don't get dinged with unnecessary interest and penalties. Okay, now before we continue along within the calculator, let's do a quick concept check. The minimum safe harbor right here, this 44,238, that is ultimately based on a prior year number, 110% of the prior year tax. So going back here to this original fact pattern, I said assume you did a Roth IRA conversion of $50,000 on August 1st, 2025. Just based on that statement alone, let me ask you this question. Does this statement matter based on what we are seeing in the safe harbor calculator so far? Let's rephrase the question so that everybody understands. Right now we are looking at a minimum safe harbor required of 44,238, and that amount is based solely on prior year information. This question right here about a current year Roth IRA conversion is current year information. Therefore, if you're basing your safe harbor estimates for the current year on prior year information, does a fact from the current year actually matter for purposes of figuring out your estimates? And the answer is no. This information, the fact that you generated income of $50,000 in Q3 of 2025, this information is not relevant if you are basing your estimates on a prior year amount, which you are allowed to do. That is one of the safe harbors, 100 or 110% of the prior year tax. It makes absolutely no difference what your current year tax or in what quarter your current year income is generated if you are basing your estimates on the prior year. So let's go back over here to the calculator. This 44,238 is going to be divided up between the 4 quarters on a pro rata basis. Each quarter, in order to meet the estimated tax safe harbor, we would be required to have paid in this fact pattern, at least $11,059. Remember, the safe harbor is not only about a total amount due for the year, it is about timing. 1/4 or 25% of that total is going to be due per quarter. So moving along in the calculator, the next item that we need to know is the prior year overpayment applied to the current year, if there is one at all. If you have one, you would get it off your prior year tax return. In this example, your 2024 tax return. And let's just assume for this example that it's $2,451. So in other words, we had an overpayment on the 2024 tax return of this amount. And instead of refunding it, we chose to apply it to 2025, and therefore we would put that amount right here in this cell. Now, the next item we need to know about is withholding. Do you have any current year withholding expected or projected? If you are still employed and you're a W-2 employee, you would probably be expecting a certain amount of withholding for the current year. If you are retired, you may or may not be expecting withholding. That's going to be dependent on whether you choose to withhold from distributions from your IRAs or from your regular brokerage accounts or from any source of money where you can actually have withholding completed on your behalf. But you're going to need to know what that amount is, or at least an estimate of what that amount is. For this example, we'll assume it's $15,000 for the year. Now, what is the default treatment by the IRS when it comes to withholding? And the answer is the IRS treats withholding as occurring pro rata throughout the year, meaning evenly throughout the quarters. It doesn't actually matter when the withholding occurred. Now, that default treatment could be an advantage to you. It could be a disadvantage to you. You can also make it an advantage to you through some advanced tax planning strategies. But for the moment, let's just assume that this withholding is being treated pro rata under the default. And therefore, the IRS would assume that 25% of this $15,000 of annual withholding is going to be allocated to each of the 4 quarters. So we're going to have $3,750 of withholding deemed to occur in each quarter. Okay, the next item in the calculator is going to be the total amount that you have paid in already prior to determining your estimated tax payment for the quarter. In this case, we have $2,451 of overpayment applied. We also have $3,750 of deemed withholding in Q1. And therefore, when we total those two up, we have $6,201 already paid in for Q1. We have a minimum safe harbor due for the quarter of $11,059. So we take the minimum amount due and we subtract off the total amount that has already been paid in, leaving an estimate due of $4,858 for Q1. We are now working on Q3, so let's assume Q1 is already done and your actual estimated payment made was $5,000. You're one of those people that likes to round up. A lot of people like to do that. They see an estimate due like $4,858 and they go ahead and cut a check for $5,000. They round up. And therefore, on this line right here, we would have an overpayment or an underpayment for the quarter, just depending on how much you paid versus how much was due. In this case, we paid a little bit more than what was actually due for Q1, and therefore we have an overpayment indicated by a negative number on this row of $142. Then let's quickly run through Q2. We have the same $11,059 minimum estimate due due. We have the same $3,750 of withholding deemed to occur in Q2. We have the $142 overpayment from Q1 carrying and applying to Q2. The grand total paid in so far is therefore the withholding plus this quarterly carryover, which is a grand total of $3,892. We take our $11,059 total amount due. We subtract off the amount already paid in. That gives us a Q2 estimated payment of $7,168. You like to round up, so you paid in $7,500, giving you an overpayment for the quarter of $332. Now we're going to go to Q3. This is the quarter that we are currently working on. We do have the same amount of safe harbor minimum estimate due right here, $11,059. We do have the same amount of withholding deemed to have occurred in Q3. We have the $332 overpayment that carried to Q3 from Q2. That gives us a grand total amount paid in so far of $4,082. We take our minimum required estimate of $11,059. We subtract off our $4,082, leaving an amount due for Q3 of $6,977. So going back to the original question once again, do you need to make an estimated tax payment of the $50,000 Roth IRA conversion times your 24% projected marginal tax rate equals $12,500 of estimated tax payment by September the 15th? If you ever see a question like this, what are the first few things you're going to say? Number one is going to be there is not nearly enough information presented right here in this fact pattern or in this question for you to be able to appropriately answer that. Going back over here, the first thing you need to know in order to determine your estimated tax payments for any year is the prior year AGI and your prior year total tax. Is your prior year AGI or prior year total tax presented anywhere in this fact pattern? And the answer is no. Therefore, you do not have sufficient information to answer the question about whether an estimated tax payment of any amount is due for the current quarter. In addition to that, you're going to need to know your current year total tax projected based off the personal tax planning template if you want to see if you can get a lower minimum required estimated tax payment due for the year. It is not required that you compare these two together. You can just calculate the safe harbor based off the prior year and go with that. It makes absolutely no difference what your current year projection is, unless, of course, let's go right up here to this. Let's just say we were expecting lower income and therefore lower tax in the current year versus the prior year. I'm just going to go ahead and change this number to a lower amount for purposes of this example. In this case, because the current year total tax projection is sufficiently lower than the prior year actual tax, the 90% of current year safe harbor would be dramatically lower than the 110% of prior year. Therefore, instead of a grand total of $44,000 due in estimated tax payments, we could drop that down to $28,000 in this fact pattern. But the only way you would be able to determine that is to know what your projection is for the current year, and for that you would need to use the personal tax planning template, which I've mentioned several times before. In addition to that, even if you're only basing it off of the prior year, what other information will you need to know in order to determine what your estimated tax payment is for Q3? And the answer is the other items highlighted in green within the calculator. Number one, you will need to know what your projected withholding is for the current year, if any. Again, if you're retired, this could be zero. You're going to need to know what your overpayment applied was from the prior year tax return, and you're also going to need to know how much you paid in the prior 2 quarters right here. Only after you have all of this information highlighted in green right here, over here, and then these items right there. Only after you have that and enter the data into the Safe Harbor estimated calculator will you actually know what your Q3 quarterly estimated tax payment is using the Safe Harbor method. If you have watched this video and you find these concepts confusing, I highly recommend you search on YouTube for this video right here. This video will teach you the fundamentals of estimated tax payments in more detail than we have gone through right here. My assumption for the video that you just watched is that you have already watched this video right down here, Estimated Taxes Safe Harbor. This is a full example that takes 70 minutes, but it is worth your time to watch once in your life. After watching this video, you will understand the fundamentals, the basics of how to calculate estimated taxes under the Safe Harbor. You can find a link to this video in the description below the video you are currently watching on YouTube. You can also search on YouTube for Number Crunch Nerds Safe Harbor Estimated Taxes. In addition to that, if you want to take your estimated tax knowledge to the next level, I do have an advanced estimated tax video training. This advanced training includes the Safe Harbor method calculator, which you saw me demonstrate within this video, as well as the annualized income installment method calculator. As part of this advanced estimated tax video training, we will cover the Safe Harbor method versus the annualized income installment method. We will cover the election to treat withholding as occurring when it actually occurred. We will cover what to do if you are underpaid in Q1, Q2, or Q3 for the year. We will deal with uneven income or uneven transactions, and how and when you can best employ the various types of tax planning strategies related to making estimated tax payments so you avoid getting dinged with that unnecessary interest and tax penalties. That's why we call this No Dings Estimated Tax Advanced Training. You can find a link to that program in the description below this video. And that's going to be it for today's video. Make sure to calculate and determine if you owe estimated tax for Q3. And if you do, make sure to get that estimated tax payment in by September the 15th. For those of you prepared to take things to the next level, I look forward to seeing you inside of No Dings Estimated Tax Advanced Training. And for everyone who is not already in the personal tax planning template program, make sure to hop in and get started with your tax planning as we draw to a close in 2025. There are only 4 months left to complete your conversion for the year and to get any remaining tax planning items in order. There is no better time to get started than right now, because December 31st is going to be here before you know it. And remember, for a Roth IRA conversion, there is no additional time to April 15th of 2026 to get that conversion completed. It must be done by December 31st, 2025, and you don't want to be scrambling to figure out your projections at the last minute, because that is how people make mistakes. So that's it for today, everyone, and I will see you in the next video.